Cryptos are all the rage these days. It seems like everyone is trying to get in on the action. So much so that people who have never invested, not even in the stock market, are trying to get a piece of the pie. New cryptos are popping up every day and older ones such as Bitcoin are reaching new peaks. Cryptos have captured the attention of potential investors everywhere. Unfortunately, they've captured the attention of another group as well. We're talking about the scammers. Beware of the crypto pump and dump scheme. Welcome to Crypto Sketch 101. We're the #1 go-to spot for all things crypto, and we're glad you've stopped by. In today's video, we're going to be talking about the crypto pump and dump scheme. What is it and how does it happen? What are some examples that have happened recently? And lastly, how can you protect yourself from them? Stick around to the end to find out. Pump and dump schemes have been around for years. With the rise of cryptos and social media, the delivery may have changed somewhat, but the scheme is mostly the same as it's always been. In its simplest form, pump and dumps are designed to make big money for its organizers while leaving investors out to dry. In the old days, pump and dump schemes were done in the stock market via cold calling. The schemes targeted small and microcap stocks that were traded over the counter, meaning they were traded via a broker-dealer network instead of on a centralized exchange such as the Nasdaq or the New York Stock Exchange. Small and microcap stocks were the easiest to price manipulate and push higher, making them the preferred target for scammers. The scammers would buy up tons of shares at a low price, then go to work promoting the stocks as the next big thing. Perhaps claiming that there would be upcoming announcements that would send the stock skyrocketing. The inflow of new investor money would lead to a sharp price increase of the stock. Once the price of the stock shot through the roof, you guessed it, the scammers would sell at a huge profit, sending the price of the stock crashing and leaving the new investors with nothing. In today's crypto world, the concept is very much the same. Organizers buy up hundreds of thousands or even millions of shares of a smaller crypto because it is much easier to manipulate a smaller crypto's price. As you'll see later, however, larger cryptos are not fully immune from this scheme. Once they've accumulated their shares, they begin spreading the news about this crypto. And while the method may be the same, the tools of delivery have certainly changed. Gone are the days of cold calling. Instagram, TikTok, Twitter, Facebook, and other social media platforms are now the preferred means of promotion. You may be asking yourself, isn't this illegal? In the regulated stock market, pump and dumps absolutely are. What about the crypto markets? Well, this is where there's a little bit of gray area. On regulated crypto exchanges such as Binance, they are. But there's a large part of the crypto market that is unregulated. Because it's unregulated, scammers believe that there is a lesser chance that they can be caught. What are your thoughts so far on pump and dump schemes? Do you feel like organizers are really doing anything wrong if there are no rules against it on unregulated crypto markets? Leave your thoughts in the comments below. Now that we know what a crypto pump and dump is and how it works, let's take a look at a real-life example. As we mentioned earlier, pump and dump schemes traditionally target lower-priced cryptos because their prices are easier to manipulate. But that doesn't mean that larger cryptos can't be targeted as well. Back in September, a fake press release on Globe Newswire threw Litecoin and the world's largest retailer, Walmart, into the spotlight. The release claimed that Walmart had announced a partnership with Litecoin and that Walmart would begin to accept Litecoin as payment in their stores. The release quickly spread on Twitter, Facebook, Instagram, and other social media platforms. Within minutes, Litecoin's price jumped over 30%, but fell just as quickly as the schemers began to take their profits, and word began to spread that the news release was fake. Globe Newswire issued a notice to disregard the release and later claimed that a fraudulent user account was used to issue the release. For the schemers, it was a hefty payday. For those looking to get in on the action, not so much. So how do you protect yourself from being on the wrong end of a crypto pump and dump scheme? Before we get into that, if you're enjoying the video, be sure to subscribe to our channel and hit that like button. Doing so supports the channel and helps us create more videos for our audience. So back to it. How do you protect yourself from these schemes? Well, the obvious answer is to just stay away from them. But that can be easier said than done. As humans, we're an emotional bunch. Oftentimes, emotional decisions don't work in our favor. Everyone at some point has suffered from FOMO, or the fear of missing out. We're always looking for opportunities, especially when it comes to making a quick buck. But here are 3 things that you can do. Number 1. Do your homework. Don't just take someone's word for something, especially if you see it on social media. Do your own research. What are the underlying fundamentals of the crypto? What are its short and long-term objectives and goals? Number 2. Look for the red flags. If a crypto is taking off out of nowhere, what's the reason? What's pushing the crypto's price up so fast? This can be a tricky one. In the case of Litecoin and Walmart, the news appeared to be coming from a legitimate source. Oftentimes also, the news is being pushed by the pump and dump schemers themselves. Is there a popular influencer on social media that has never had anything to do with cryptos, all of a sudden promoting one? That's a red flag. Number 3. Lastly, and perhaps most importantly, don't invest anything you can't afford to lose altogether. Even though the first crypto was developed over a dozen years ago, crypto trading is still fairly new and very volatile. Price swings can go up or down dramatically in just a short time. Don't invest anything you can't afford to lose. Doing so will help you make fewer emotional decisions. It's better to be in it for the long haul than to execute a trade with the hopes of making a quick buck. That's all we've got for today. Hopefully you've gained a better understanding of what a crypto pump and dump is. We're able to see a real-life example of how one is executed, and gained a little bit of perspective on how to avoid being caught up in one. Drop us a comment below on what you think about the video, and leave us a comment as well if there's any future topics you'd like us to cover. Once again, if you enjoyed the video, be sure to give it a like and subscribe to our channel. Thanks for joining, and we'll catch you in the next video.